Okay, ladies and gentlemen, good afternoon. I would like to welcome you here in this beautiful auditorium in the name of Tatrabanka Foundation, CERGE-EI, and Comenius University, the three co-organizers of this event. My name is Peter Katuszczak. I am a faculty member at CERGE-EI in Prague, and it's my privilege today to introduce Professor Maskin. Before we get there, let me just say a few words about CERGE-EI. That abbreviation stands for the Center for Economic Research and Graduate Education at Charles University in Prague, and also the Economics Institute at the Academy of Sciences of the Czech Republic. We are a joint workplace of these two institutions. Our flagship program is a PhD in economics, and over the years, we've had students from over 30 different countries in the program, including many students from Slovakia. Okay, so that said, let me now move on to introduce our distinguished speaker. Again, it's a great honor to be here today and to present together with our partners, Tatrabanka Foundation and Comenius University, Professor Eric Maskin, who is the 2007 Nobel Laureate in economics. Professor Maskin obtained his bachelor, master, and PhD degrees from Harvard University. He received his PhD in applied mathematics in 1976. After that, he spent 1 year at Cambridge University in England as a research fellow. He spent the following 8 years back in Boston at MIT, first as an assistant professor and later as a full professor. In 1985, he moved to Harvard, where he later became the Lewis Berkman Professor of Economics. In 2000, he moved to the Institute of Advanced Studies at Princeton University, actually lived in the house of Albert Einstein, and he was the Albert Hirschman Professor of Social Science. Last year, in 2012, he returned back to Harvard, where he is now the Adams University Professor. So Professor Maskin is known for many different contributions. He's probably most well known for his work on mechanism design and implementation theory. But he also worked a lot in game theory, for example, dynamic games, contract theory, economics of innovation, or electoral rules. Professor Maskin is a member of many different professional societies and organizations. At the age of 30, he was elected to be a fellow of the Econometric Society, which is a great honor at such a young age. And later he served as the president of the Econometric Society, also as the president of the Game Theory Society. He is a fellow of the European Economic Association, the American Academy of Arts and Sciences, the Society for the Advancement of Economic Theory, and he is also a class member of the National Academy of Sciences. He holds honorary degrees from several universities worldwide, and he served in editorial positions of many academic journals over his career. Now, Professor Maskin has not only been working in academia, he also applied his knowledge outside of academia. In the 1990s, he helped the Polish government to design privatization auctions and the Italian government to design auctions of treasury bills. Later, he also worked with the British government on auctions for greenhouse gas reductions. He also worked as a consultant for several companies on matters of antitrust and intellectual property. In recognition for his research achievements, he received the 2007 Nobel Memorial Prize in Economics, together with Leonid Hurwitz and Roger Myerson, for having laid the foundations of mechanism design theory. So today, we are very honored to welcome him here today as a speaker in the Tatrabanka Foundation series. Let me just say he's the 6th Nobel Prize winner in economics who is going to speak in this series. And today he is going to share with us his ideas on the financial crisis. The title of his lecture is Financial Crises, Why They Occur and What to Do About Them. So without further delay, ladies and gentlemen, Eric Maskin.
Thank you very much. Thank you, Peter, for that lovely introduction. Thank you for your warm welcome. It's been a pleasure visiting Bratislava. My wife and I arrived yesterday to glorious weather. It's been so nice to walk around a bit outside and see the sights and meet the people. So thank you all for the warm welcome that we've received. As the title suggests, I would like to talk about financial crises today. I am an economic theorist, which means that I don't study particular events. I'm interested in how different economic events relate to one another. And so, although I will make some references to the big financial crisis that we've all withstood and are still trying to recover from, I would like to talk more generally about financial crises through history and what connects them. In fact, there have been many financial crises over the last few hundred years. There was a very famous one in the 18th century, which nearly destroyed the British economy. So we have a long history with them, and no doubt, no matter what we do, we will continue to have financial crises in the future. That's because even if we correct what went wrong the last time, there will always be new things that we didn't think of that will cause crises in the future. For that matter, as I will come back to at the end, even if we could stop crises, we might not always want to take such extreme action as to prevent them altogether. What we can do is to reduce their probability of occurring, and we can also limit their effects. And I'd like to devote most of my time today to saying what we can do to reduce the probability of crises and to make sure that they don't spread too far. So there are several theoretical questions I would like to address in today's talk. First, what is different about financial markets, credit markets, and other markets? Why do we keep having crises in the credit market, and yet there are plenty of other markets where things seem to work just fine almost all the time? A related question is, why do we need such serious government intervention in the credit markets? Government has to come in and bail banks out. It has to come in and regulate. And yet, government presence in most other markets is often absent almost altogether. And then the third question is, what can we do before a crisis occurs to either prevent it from coming or at least limiting its effects? So those are the main questions I would like to talk about. Before I get into the cause of financial crises, the most recent one, and crises more generally, I'd like to mention a few factors which are often discussed, particularly in the popular press, but which, in my view, are not primary causes of financial crises. And there's a long list. First, irrationality. By irrationality, I mean people or institutions not acting in their own self-interest. Now, of course, in this most recent crisis, there were plenty of examples where people and institutions did seem to act against their own interest. So for example, there were banks that made loans to people who were unlikely to repay those loans, and there were borrowers who got loans even though they later discovered that they couldn't pay them back. So there was a certain amount of irrationality, but what I'd like to argue is that irrationality was not at the core of what went wrong. What about panic? Well, many of you may remember that in September of 2008, the investment house Lehman Brothers failed, and indeed the consequences of that failure amounted to a worldwide panic in financial markets. There was a dramatic crash of the stock markets, and if the U.S. government could have replayed those events and come in and saved Lehman Brothers, I'm sure they would have done so after seeing the panic that the failure of Lehman Brothers gave rise to. But of course, by then it was too late. So this panic was a serious event. But again, I would argue that we would have had a pretty serious financial crisis even without that panic. What about greed? Did greed play a role? Of course, the distinction between greed and interest in earning profit is not so easy to draw. Where does a healthy profit interest end and greed begin? What I would like to argue is we don't really have to distinguish between profit interest and greed to understand financial crises, because they really have nothing to do with greed at all. In the same way, I would argue that although, of course, there was a certain amount of unethical behavior exhibited before the last financial crisis, it can be argued that some of the loans that were made were not fully explained to the borrowers who got those loans. Again, this unethical behavior was secondary to the main forces that drove the crisis. Then sometimes it's argued that the crisis had macroeconomic origins. There was an imbalance between too much consumption in the West, particularly the United States, too much saving in the East, particularly China. Of course, it can't be denied that the consumption patterns of the U.S. and China are very different, but as you will see, the argument I will lay out really has nothing to do with consumption and saving. Sometimes the recent crisis is blamed on the fact that there were very complicated derivatives. Derivatives are financial instruments which enable you to take the risk on one investment and turn it into risk on another investment. no doubt there were plenty of complicated derivatives, but again, they weren't an essential part of the story. Sometimes bankers are blamed for the crisis. The fact that they were receiving bonuses for making loans, which later turned out to fail. Again, bonuses, as you will see, are not the heart of the matter. And then finally, it's sometimes argued that the reason we had a crisis is because large banks knew that whatever they did, they were going to be bailed out because they were somehow too big to fail. I think that argument also misses the main point. So if all of these different factors I've just discussed were not the reason why this financial crisis and previous financial crises occurred, you might ask, well, what was the reason? And that's what I want to turn to now. And to do that, let me first try to explain how the credit market is different from other markets. First of all, there's an obvious way that the credit market is different. There's a sense in which the credit market is essential in a modern economy the way that almost no other market is. So if there's a crisis in the market for potatoes, well, that might be a bad thing for people who deal in potatoes and people who like to eat potatoes, but it's not going to destroy the rest of the economy. It's not going to ruin the market for automobiles, for example. But if there's a crisis in the credit market, as we saw a few years ago, that affects every aspect of a modern economy. There is no part of a modern economy which can continue to function normally if the credit market doesn't work. So that's a pretty obvious point. A less obvious point, I think, is that there's a sense in which the credit market works in exactly the opposite way from other markets. So in the credit market, a small shock, a small adverse event can often get magnified through subsequent reactions. So the small shock gets bigger, whereas just the opposite is true of, say, the potato market. In the potato market, if there's a shock, if some potato growers fail because of a drought, for example, that's not going to cause other potato growers who are in some other region to fail. Quite the opposite. They're likely to be in a stronger position. But if some banks fail because of a shock in the mortgage loan business, if some banks have made bad mortgage loans, that's not going to it's not going to stop there. It's likely to cause banks, even banks that don't have anything to do with mortgages, to get into trouble. And I'll explain that in a few minutes. A related point is that there's a sense in which the credit market is not self-correcting the way that many other markets are. So again, if some potato growers fail, other growers in some other part of the world will increase their production to make up for the lost potatoes, and that will, in a sense, correct the original shock. We don't need the government to get involved, but if some banks fail, we can have a chain reaction of bank failures, which leads to what's called a credit crunch. We saw exactly that occur several years ago. The whole credit market can get stuck, and outside intervention, in particular by the government, is very much needed. So I'd like to spend some time discussing the second and third points because they're less obvious than the first point. So let me, please excuse me, but I think using the potato market as a way of contrasting how normal markets and credit markets work, it makes for a good example. So I'm going to keep coming back to potatoes. Let's imagine that something goes wrong with the potato crop in Ireland. There's a blight which wipes out the potato crop. Well, what will happen? The first thing that will happen is that because there are now fewer potatoes than there were before, or than there were expected to be, we will see an immediate rise in the price of potatoes, not just in Ireland, but probably worldwide, because Irish potatoes are exported worldwide. But that's not the end of the story, because the higher prices will induce potato growers elsewhere, in Slovakia, for example, to increase production and sell more potatoes. And so this is the sense in which the potato market is self-correcting. It's true that a crop failure in Ireland will hurt consumers because the immediate effect is that they will face higher prices, but these high prices induce suppliers elsewhere to increase production and correct the failure in Ireland. And so in the longer term, the potato market is back more or less where it was in the first place. And the potato market is self-correcting. And we don't need government to get involved. In fact, government, if it did get involved, might actually make things worse. A very natural inclination on the part of a government when there's, say, a crop failure, a potato crop failure, is to step in and put a cap, a limit on how high potato prices might go. Or another thing they might do is to try to tax the additional profit that the remaining potato growers enjoy. And those actions are quite understandable. The government is trying to protect consumers from these higher prices. But there's a sense in which these actions by government, even though they are very well-intentioned, work against consumers' interests in the longer run because they discourage the expansion of output by other growers that higher prices would normally induce. So government interference in the potato market not only may not be needed, but it can actually make things worse. Now let's compare that with the credit market. I'm arguing that the credit market is just the opposite. So how does the credit market work? Here's a very stylized, very simplified version. The credit market consists, first of all, of entrepreneurs. Entrepreneurs are the people who have ideas for productive projects, but they don't have the money to finance these projects. So what do? They go to banks. And I'm going to use bank as a the term bank is a general catch-all term for any sort of financial institution which makes loans. What banks do, first of all, they have money. They have money often because people deposit their savings in these banks. And furthermore, they can evaluate the entrepreneur's ideas and make at least a guess about whether these ideas are likely to work out. And then they lend the money to the projects which look good, to the entrepreneurs with the good ideas. Now, that's a little bit too simple. Let me complicate things a little bit more. Typically, a single bank is not going to have enough money itself to finance all of the good ideas that it comes across. So what banks often do is that they borrow money themselves, perhaps from other banks, and they use this borrowed money to finance some of the good ideas. This is what's called leverage. When banks use borrowed money to make loans, they are taking on leverage, and this enables the bank to increase its profits. For example, if you're a bank and you've come across a good idea that has a 20% return, if you put $100 of your own money into that idea, then you expect to get $120 back. So you've made a 20% return, $120 minus $100. But if you also borrow $900 from other banks and you put that into the good idea, then you're going to get back $1,200 in all. You will have to repay the $900 you've borrowed from the other banks, but that leaves you $300 profit for yourself. That's a 200% return. So leverage enables a bank to dramatically increase its return on investments. And that's obviously good for the bank. It increases the bank's payoff, but it's also good for the whole economy. It's good for the whole economy because it allows more good ideas to be financed. And that's good for innovation, and it's good ultimately for the entire society. You get more growth that way. Unfortunately, there's a problem with leverage. There's a complication with leverage, which is that so far I've omitted the fact that these projects, these good ideas, might be risky. So let me introduce risk. Typically, if banks are funding new ideas that are not sure things, usually there's some chance that the idea will pay off, maybe a good chance that it will pay off, but there's also a substantial chance that the idea might fail. And so a bank is in effect making a bet when it invests in a new idea. And leverage increases the risk of that bet. So if you invest $100 of your own money and you lose the bet, so the project doesn't work out, well, you've lost $100. But if you also invest $900 of other banks' money and the project doesn't work out, now you've lost $1,000. And so it's easy to see that a bank that is highly leveraged may fail altogether if it loses a few big bets. Now, what is the danger from failure? there's a sense in which we don't worry about banks failing if the failure is confined to the original bank. If you've invested $100 and the idea doesn't work out and you lose your $100, well, that's life. That life involves taking risks, and sometimes the risks don't work out. But the problem with leverage is that it implies that the bank making the investment is not the only one that pays the consequences. Other banks are affected too. So if the new idea turns out not to work out, the bank making the investment may fail, but the banks that lent money to that bank may also fail. In other words, there can be a chain reaction of failure due to the fact that there are perhaps many banks involved. And this is what is called systemic risk. Systemic risk is a consequence of leverage. So I argue that leverage can be a very good thing for the economy, but it can also be a very bad thing if it leads to systemic failure. And this highlights an important way that the credit market is different from the potato market. A small problem, a relatively small problem in the credit market can get bigger because of leverage. The small problem may initially affect just a few banks, but because they're highly leveraged, lots of other banks will be implicated as well. A few bank failures can lead to an epidemic of failures, whereas, as I was arguing, a small problem in the potato market stays small. It doesn't spread and envelop the entire potato market. The potato market is self-correcting. The credit market is not self-correcting. The initial problem can get worse. And we can even end up, as we saw a few years ago, with a paralysis of the credit market where basically no bank is willing to lend. And notice that this doesn't depend on irrationality or panic. This analysis did not invoke irrationality or panic. Everyone was behaving completely rationally and without fear. It's just that because of leverage, every bank is connected to other banks, and that's just a structural difference between the credit market and the potato market. So economists would describe what's going on in the credit market as an externality. If I'm a bank and I'm leveraged, I exert an externality on all of the banks who are lending to me whenever I make a risky loan. An externality is just an effect that you have on other institutions or other people that you don't have the incentive to take into account yourself. I don't, as a bank, I don't have the incentive to worry that you, as another bank, might fail if my investment doesn't work out. I exert an externality on you. I have an effect on you, but I don't have the incentive to take that into account when I make the loan. So I may be putting you in jeopardy, but the system doesn't require me to take that into account. that doesn't make me irrational or unethical or greedy. It just means that I, as an individual bank, have the incentive to look at my profit, not your profits. The unfortunate thing is that in markets like the credit market, where there are big externalities, things don't always work very well on their own. And to give another example of a market that doesn't work well because of big externalities, just think of the market for clean air. Now you might ask, is there a market for clean air at all? We don't seem to see one. In fact, there is a market for clean air, but it works so badly that we don't even notice it. So let me explain what I mean. Suppose that there is a steel plant, so that this plant makes steel. In the course of producing steel, the plant puts a lot of smoke into the air, so the steel plant makes the air dirtier. Suppose that you're a laundry. You're in the business of getting clothes clean, and you're right next door to the steel plant. Well, your job is going to be a lot harder with all of this dirt in the air. The steel plant is exerting a negative externality on the laundry. Now, that isn't to say that the laundry can't do anything about it. The laundry could go to the steel plant and offer to pay to have the steel plant reduce the smoke into the air. So there is potentially a market for clean air. The complication is that this smoke that the steel plant is producing doesn't just affect the laundry next door, it affects many other enterprises as well. And if the laundry pays the steel plant to reduce the amount of smoke in the air, it's not just benefiting itself, it's benefiting all of these other enterprises too, but it has no way to increase its own profits by helping these other enterprises. And therefore, the laundry is not likely to reduce the amount of to pay for enough smoke reduction to help these other enterprises sufficiently. In other words, there might be some smoke reduction, there might be a market for clean air, but it's probably not going to reduce the amount of smoke in the air very much, because the laundry doesn't have the incentive to help all of those other enterprises and all those other people who would benefit from the smoke production. So without any intervention, we're not going to have clean air. We're going to have pretty dirty air. So what is the solution? The solution is for the government to get involved and to either put a limit on how much smoke the steel plant can put into the atmosphere, or tax the emissions by the steel plant. The government needs to take some sort of action to reduce the amount of smoke. Now, I would argue that just as smoke causes the problem in the market for clean air, in the credit market, it's risk and leverage which cause the problem. And just as the government could step in the market for clean air and limit the amount of smoke, we also need intervention in the credit market. In fact, I'm going to argue we need two kinds of intervention. We need intervention after the crisis occurred, because no matter what governments do, they can't anticipate everything that might go wrong in the credit market, and so there has to be something that government can do after banks get into trouble. So I'll call that ex post intervention. But government should also at least try to stop crises from occurring in the first place, and that's what I will call ex ante intervention. So let me start with ex post intervention. Once we have a financial crisis and banks are getting into trouble, what can government do? Well, if some banks have got into trouble, what the government can do is to bail them out. And by that I mean the government can provide enough capital so that these banks can continue to function. Now, why is that important? It's important not so much to save these banks that are in trouble, but it's important to make sure that other banks who would fail if these first banks disappeared don't also get into trouble. So the primary reason for a bailout is to protect the system as a whole, not to save the particular banks that have got into trouble. Unfortunately, bailing banks out comes at a cost, and the cost is something that I already mentioned, which is that if banks expect that they will be bailed out when they get into trouble, they have less incentive to limit the risks they take. If I know that you're going to save me if I jump off the cliff, then I don't worry so much about staying away from cliffs. So, ironically, the ex post solution, the after the fact solution to financial crises can actually increase the probability that a crisis will occur in the first place. And that's why an ex post policy by itself is not enough. What we also require is an ex ante intervention, and that takes the form of regulation. I was arguing before that banks that individually do not have the incentive to take into account that the risk and the leverage that they assume can affect other banks. But government does have the incentive to take these externalities into account, and regulation can limit what banks are allowed to do. So there are two reasons why this regulation is necessary. First, as I was just saying, if we only had ex post intervention, if we only had bailouts, then banks wouldn't take sufficient precaution to avoid risk. But even if they didn't expect bailouts, as I've been arguing, banks have the incentive to concentrate on their own profits, not on the profit of other banks, and because of risk and leverage, banks undervalue the jeopardy that they are imposing on other banks. So we need regulation to limit those risks and that leverage. So what form should regulation take? Well, I think the the two most important forms of regulation are, first of all, minimum standards on loans. So one of the problems that started the most recent financial crisis were these so-called subprime mortgage loans, where borrowers who didn't have much prospect for repaying the loans were nevertheless able to get loans in order to finance their homes. If there had been minimum standards on loans, if the government had required that borrowers pass some minimum requirements in order to get a loan, we might not have had this financial crisis in the first place. So minimum standards are one form of regulation, but I think even more important is that there be limits on leverage. That means that banks are limited to the extent that they can borrow money from other banks. They have to put a sufficient amount of their own money into the project in order to meet the leverage cap. So those, I think, are the two most important forms of regulation. Let me briefly mention a few others, but these others are, I think, not as important as the two I've just mentioned. One kind of regulation might be to limit derivatives. You may have heard of the infamous derivatives called credit default swaps. Credit default swaps were ways that institutions tried to protect themselves from the failure of their creditors, and credit default swaps can serve a useful function in a modern economy, but they in effect increase the risk of systemic risk, of a chain reaction of failures. And so there may be reason to place restrictions on derivatives and at the very least to make derivative trading more transparent, so that you know who has traded in derivatives and how much they've traded in derivatives. Another form of regulation that has been discussed is regulating the size of banks. Now, you often hear the phrase "too big to fail." That the problem with big banks is that they have to be bailed out because if they fail, the consequences are too drastic for the economy. I would like to argue that there may be a problem with banks that are too big, but it's not that they're too big to fail. And let me explain what I mean. Notice that according to my argument, it's just as bad if a lot of little banks fail as if one big bank fails. You have the same consequences for the rest of the economy. So the fact that a big bank needs to be saved is not an argument in favor of smaller banks per se, because the small banks should be rescued too. Nevertheless, there is a sense in which big banks can cause a problem, and that's because, as I've argued, all banks, big banks and small banks, have an incentive to take on more risk than is good for society, because they ignore the externality they create. And in particular, the fact that they're taking on too much risk means that they're not likely to have as diversified a portfolio of loans as would be best from the point of view of society. And because of this lack of diversity, that increases the probability that a bank might fail. Of course, this is true of both big banks and small banks. Both big banks and small banks have some probability of failure because of lack of diversification. But there's a sense in which you get automatic diversification if there are lots of small banks, because each little bank is doing something different from the other banks. And so you get a certain amount of diversification for free just by virtue of the fact that they are different banks. Whereas if you only have the one big bank, well, it's just doing what that big bank does, so you don't get as much diversification as you might if they were if there were small banks in that big bank's place. So this is an argument in favor of smaller banks. It's not the standard argument. It's not the too big to fail argument. It's a diversification argument. Now, I've been arguing that we can understand financial crises without appealing to irrationality or panic or greed, unethical behavior, derivatives that are hard to understand, bonuses, or the too big to fail arguments. The argument that I've given says that financial crises are caused by the fact that when a bank takes on risky loans and is highly leveraged, it's going to be affecting other banks too. Second, if a bank expects to be bailed out, it's going to take even riskier behavior than it would otherwise. So for those reasons, we need to have bailouts. It's an unhappy fact of life, but we do need to have bailouts if a crisis occurs. But better still is to try to prevent the crisis from occurring in the first place through regulation. So regulation is the key message of my talk today. Now, I'm not suggesting that we can design a perfect regulation bailout package. I think we can do a pretty good job of stopping many crises from getting started with proper regulation. And I think we probably could have stopped the most recent crisis if there had been some minimum standards on mortgage loans. But the amount of regulation that we would need to guarantee that we would never have a credit crisis would probably also stifle all creativity. That is, good regulation has to strike a balance between stopping crises and at the same time allowing for innovation. We don't know what kinds of innovations banks will think of, what kinds of creative loans that banks might make, and we don't want to stop all of this innovation. It would be nice if we could finance only the good innovations and not finance the bad innovations, but it's very difficult to tell in advance what's good and what's bad. So, as I said, there's a trade-off between the stability of the system and the creativity of the system. Nevertheless, we have a important historical experiment. As you all know, there was a huge financial crisis in the 1930s, and as an outcome of that crisis, a fair amount of banking regulation was put in place, regulation which lasted for about 40 years until deregulation began in the 1980s. During that 40-year period of about 1940 to 1980, we saw a great deal of growth, a great deal of creativity, and we also saw almost no financial crises. In other words, we were able to get the balance right. This historical period proves that it is possible to have effective regulation which is not creativity-destroying regulation. Now, I don't know whether we can always get the balance right in the future, but we can certainly do a much better job than we've done in the recent past. And with that optimistic observation, I'd like to thank you for your attention. Thank you very much.
Okay, so thank you very much for a thought-provoking presentation, and on this note I'm opening up a discussion. So if you have a question, then please raise your hand. Somebody will help you around with a microphone. Okay, so I see a few hands there, so if somebody please could hand the microphone out there.
I have one comment and actually two comments. Well, actually, this Irish potato crisis was not so innocent. It produced a lot of emigrations to America, so Irish became very influential in America and got their presidency there. Well, but this is just a joke. Another more important thing is, well, President Obama and his administration started to speak about the need of regulation of the banking system after the crisis, but then there was the midterm election to Congress, and they saw that the other party got much more sponsoring from the financial sector than the Democrats. So after that, these regulation proposals became a little bit softer. It's very hard to regulate somebody from whom I want to money for sponsoring. Thank you.
Yes, so you suggested that one problem with effective regulation is politics, and I would agree with that. One of my purposes in giving a talk like this, however, is to explain why, leaving politics aside, there's very good economic reason for regulation. I'm hoping that if enough citizens understand that it's in their own interest to have financial regulation, the political problems will be mitigated.
Yeah, I am Jan Rode here from Comenius University. Professor Maskin, I appreciate your explanation about financial crisis, but please, if we talk about financial crisis, it goes hand in hand with the risk management. So, how it is possible companies, banks, they take high risks even they have risk management systems which are usually very costly. Don't we need to improve this systems, risk management system in the banks?
We have a problem with acoustics here, so maybe if you could please just rephrase one more time the question.
Risk management, to improve risk management system in the banks, because they have such a systems. These systems are quite costly, but the result is the financial crisis.
Right.
Yeah.
So you are saying, couldn't banks improve their risk management systems?
I would suggest there will be suggestion to improve it.
Yeah. Well, in retrospect, we see that some of the risk management systems that investment banks were using had serious flaws. And of course, those systems need improvement, and many of them have been improved in the last few years. My point is that even if risk management works exactly the way it's supposed to, there's still a problem, which is that an individual bank doesn't have the incentive to take into account the losses that other banks are going to suffer. And so even if it does risk management perfectly from its own point of view, it's going to be imposing risks on other banks that it doesn't account for. And the most direct way to take into account those risks is for regulation to be designed. We see there was regulation prior to the financial crisis that suffered from flaws too. So just as risk management schemes were not well designed, the regulatory system was not very well designed. There have been some improvements since 2008. In the United States, the Dodd-Frank Financial Reform Act has been a step in the right direction, but it's not sufficient. We need more improvements to the regulatory system, and I hope that before too many years have passed, we get some of this improvement.
Okay, so let me step in with a question. What do you do with cross-border lending? I mean, look at Europe, right? We have cross-border lending, but national regulators. How do you fix the externality problem? You might say banking union. If we can't do the banking union because of political constraints, what is the next best, you think?
Well, as you point out, banking union would be a very good idea, and I'm hoping that comes to pass. In the absence of a banking union, I think the most we can hope for is harmonization of national regulations. So one of the current difficulties is that if some countries are regulating properly and other countries are not, capital can move to the countries where the regulation is less onerous. This is a world where capital can move easily, and that's a good thing. But if it always moves to countries where there's less than sufficient regulation, that's a bad thing. So even in the absence of a banking union, we can hope for more harmonization, more regularization of domestic regulation, so that different countries are doing more or less the same thing as far as their rules on banks are concerned.
Okay. You have argued that it's better to have two small banks than one big bank. The reason being that the two banks don't have the exactly same business model. To what degree is it true? Or put otherwise, aren't banks becoming more and more similar today than they were many years ago? And this increases the likelihood that even if we have small banks, the systemic risk is much larger.
There is a sense in which banks have become more similar, and to that extent, then the argument that I made for smaller banks is weaker. Frankly, I made that argument not so much because I thought it was a central part of the talk, but only because I disagree with the conventional wisdom that the reason big banks are bad is because they're too big to fail. That argument, I think, is false because, as I was saying, having one big bank or two small banks, which add up to that big bank, fail, have exactly the same effect on the rest of the economy. If you bail out the big bank, you also have to bail out the two smaller banks. Really, the only intellectually defensible argument I would make against big banks is the diversification argument, but as you point out, even that is not is not as strong an argument as it used to be.
Thank you. Do you think that the reason for the good balance between 1940 and 1980 was because of the fixed exchange rates?
No, I don't. The fixed exchange rates may have had other benefits. It provided some stability, some additional reduction of uncertainty when it came to international investments. But the financial crises are primarily driven by leverage. And fixed exchange rates did nothing to reduce leverage. What was constraining leverage was regulation. In that period of time, those 40 years, banks were limited to leverage ratios typically of somewhere between 15 to 1 and 20 to 1. A 15 to 1 leverage ratio means that you're borrowing $15 of other people's money for each dollar that you as the bank are putting in of your own money. So 15 to 1, 20 to 1 leverage ratios were the norm then, but in the couple of years leading up to the financial crisis of 2007, 2008, we saw leverage ratios of 30 to 1, 40 to 1, even 50 to 1. That was so much higher than the historical norm that, in retrospect, it's no wonder there was a crisis. It was a crisis waiting to happen. It was a crisis that could have been limited by effective leverage regulation and was not.
But don't you think that the money was limited because of the fact that the money was backed by gold?
It's true that up until 1970, money was backed by gold, but again, that doesn't have much to do with financial crises. Money being backed by gold might have might provide some limits to how much inflation there can be. It might put some constraints on how much money can be printed on a national printing press, but it doesn't have much to do with the sort of chain reaction that we saw in 2008, where we had a sequence of bank failures. That's the theme of my talk today, chain reactions of bank failures. Pegging exchange ratios and backing money by gold is not going to stop chain reactions from occurring.
Thank you.
Well, Professor, you are saying what you are arguing is that the leverage is the key of the crisis. So why do banks then resist increasing the Tier 1 capital ratio under the new Basel Accord? Let's say to up to 9%, that would represent the roughly 10-to-1 leverage.
Well, 10-to-1 leverage actually might be too low. I was saying before that we had 40 years free of very serious financial crises where we had leverage ratios from 15 to 20. I think reducing leverage to 10-to-1 might be going too far in the other direction. That is, leverage that's too low can be harmful as well as leverage that's too high. If leverage is too low, you don't allow for enough investment.
Professor, thanks for a very nice lecture, and actually thanks for nice words about the bankers, because as I read it, what you said, the bankers are non-monsters, neither banksters. They're normal people behaving rationally according to the system. But still, do you distinguish between the behavior of investment bankers and universal bankers? Because when you mentioned the externalities, and you mentioned that the bankers are not incentivized in order to protect money of other banks when they decide about the deals and investments. Universal bankers, as we are, our bread and butter business is to take money from people and companies and redistribute them into the economy. So whenever we do that, we see, in other words, the faces of those who gave us the money, and we feel some responsibility here. So do you see the difference in behavior?
Well, I'm certainly not going to argue that banks don't try to behave responsibly. Yes, there can be important differences between the way that commercial banks and investment banks behave, because perhaps commercial banks see the ordinary citizens who are affected by their investments more directly. Nevertheless, I think all banks need some regulation. So the degree to which regulation is required may differ according to the particular kind of financial institution, but all banks need regulation because the logic of my argument applies to any financial institution. But that reminds me of a point that I'd like to make, which is one. So I talked about this golden era from 1940 to 1980, and you might say, well, what happened after that? Did we get rid of previous regulations? And to some extent we did. So one classic example of an old regulation that was eliminated was what's called the Glass-Steagall Act, which was a law passed in the United States which separated commercial banks and investment banks. And that law was repealed in the 1990s. But I think even more important than getting rid of the old regulations was the fact that the banking system itself changed so that a lot of the old regulations no longer applied to the new reality. For example, these days, in addition to investment banks and commercial banks, savings banks, we also have hedge funds. We have private equity firms. These are, in effect, banks too, but the old regulations don't apply to these new financial institutions. So part of regulation is not only having good laws in place, but updating those laws from time to time to reflect the fact that the institutions you're trying to regulate don't stay the same.
Thank you. Well, I would go back to the primary cause of the crisis, and that's to what extent Mr. Greenspan helped to financial crisis after the terror attack. So that would be the first question. The second question, to what extent...
Sorry, I didn't quite get the first question.
So, yeah, the first question was to what extent Mr. Greenspan, the monetary policy easing from 2001, helped alleviate the crisis, let's say the leverage, help leverage the banks.
Right.
And the second question would be, how certain are you that the intervention by, since 2008, by Mr. Bernanke will help solve the crisis? Thank you.
Okay, so to what extent was Alan Greenspan, who was chair of the Federal Reserve in the early 2000s, well, he was chair long before that, but the crisis was brewing in the early 2000s, and Greenspan was chairman then. To what extent was he responsible? In my view, he bears a lot of responsibility because, as he said himself, he believed that financial markets are self-regulating. He's on record as having said that he believed that banks could, in effect, regulate themselves. Well, as I tried to persuade you today, there are very good reasons why banks are not the same as potato growers, why they are not, why the banking industry, the financial industry is not the same and is not a self-regulating industry. Mr. Greenspan did not recognize the difference between finance and potatoes. He later admitted his mistake. So he, in fairness to Greenspan, he acknowledged that he made a mistake. But of course, by then it was too late. Now, what about Bernanke? Well, Bernanke took office in 2006. That was already before the crisis had started. Personally, I don't know to what extent he might have stepped in the 1 or 2 years he was in office before the crisis actually exploded and done something to hold it off. Perhaps he could, perhaps he couldn't. I can't. We will know that someday, but we don't know yet enough about what happened. But we do know that once the crisis began, Bernanke did jump in and took all sorts of steps to try to keep the banking system going, to increase liquidity, to make sure that banks did not fail. And I give him a lot of credit for that. I think the Fed's actions were very important in preventing what was already a very bad situation from becoming a complete disaster. So that there aren't too many heroes in this last crisis, but in my view, Bernanke was one of them.
Hello. I would like to ask you, are you not afraid that the higher regulation will bring even more problems, because the shareholders of the bank will demand their return on investment or return on equity, and bankers will be forced to implement new ways how to make this profit or this return, and if the traditional ways will be highly regulated, then it is highly possible that they will come up with some new ways how to do it, and those ways might be even more dangerous and may cause even bigger problems. Thank you.
Right. Well, you raise a good point, which is if you regulate in Area A, perhaps all of the investment will migrate to Area B, and that's why I was suggesting a few minutes ago that it's not enough to put a set of regulations into effect and then just sit back and do nothing else. You have to update regulations from time to time to make sure they're keeping up with what the financial industry is doing. Now, and you raise another good point, which is that there is a danger of over-regulation. I hope I've convinced you that we need some regulation because financial institutions on their own are not going to self-regulate, but if you over-regulate, you stifle innovation. And so regulation should be limited. That is, there should be as little regulation as will make the system safe, and it should be dynamic, which is it has to keep up with the times. If there are new financial institutions, they have to be brought under the regulatory umbrella as well.
Two remarks. Well, I would say in a abstract or theoretical nature. I mean, one of the differences, I think, between the other, like potato growers, you said, and the banks, is also that there is no horizontal flow among the. I mean, there are many horizontal flows between the banks. Goods or money goes between the banks, but no horizontal flows between the potato growers. There, all the flows are vertical and go from one side to the other. And goods go from, say, suppliers and go down to consumers. Money goes the other way.
Right.
And this is a second part of the difference, that the banks are somehow in a terminal position, because money goes from their clients and goes back. And so the horizontal flows and this terminal position creates a potential for many loops, feedbacks, which may be positive or negative. So this is and the other one is concerned questions about, say, somehow managing or mitigating the crisis. Of course, the ultimate goal is to mitigate the effects on people. Otherwise, it's a great thing. A crisis creates a possibility for many studies, papers, experiments, and so on. And you can do it in two ways. One of them is to control or to reduce the frequency. The other one, to reduce the amplitude of the crisis in physical terminology. And somehow it goes against each other somewhat. Sometimes I think you can prevent large crises by a small crisis. If not for other things, for instance, for learning, or it's something like immunization. So this is the other thing. The third thing is very short. I mean, you mentioned the example about price regulation for potatoes, and we experienced it because in the early 90s it was exactly this happened here in Slovakia.
I see. Well, thank you. I take what you said as more comments or elaborations on what I said than as questions. I would agree with you, in particular in your first comment, that there are more differences between the financial industry and the potato industry than the particular difference I was pointing to in my lecture. The differences that you mentioned are give even greater force to my conclusion, though, that we should think of financial markets as significantly different from ordinary consumer good markets. All the more reason why we need to have regulatory involvement.
Okay, so maybe as a follow-up, you can ask, what happened there in 1980, right? You're saying we started to deregulate, maybe banks became different. But in terms of sort of a longer-term political economy, we may have forgotten, simply. 40 years is a long time. A lot of people who run regulation, politics, even voters, may not have experienced anything like this in their lifetime, so we think this is not an issue anymore, right? So in that respect, wouldn't it actually be helpful for voters, politicians, and regulators to have a smaller crisis from time to time, to help us remember that certain kinds of regulations are necessary to avoid larger crises?
Well, a small crisis might be one way to remind voters and politicians that regulation is necessary, but it's an awfully costly way, because there are a lot of, even in a small crisis, there are a lot of people who suffer, and they're not, and they're not the regulators and the politicians. They're ordinary citizens. I think an even better way to remember the importance of regulation is education. One reason why I got into economics in the first place, and why I continue to be excited and interested by the field of economics, is that it has the potential to help us understand this very complicated world that we live in. Of course, the financial crisis that we've undergone was a very complicated phenomenon, and there were many things going on at the same time. But as I hope I persuaded you, applying a few simple economic principles enables us to see why financial crises occur not only in this most recent instance, but have occurred through history and will continue to occur unless we put into place and update a regulatory, a sensible regulatory system. That is a lesson which, as long as economists are teaching, should be, could be remembered, and sitting through an economics lecture, I think, is a far less painful way to absorb this lesson than to sit through a financial crisis.
Okay, so on this note, I'm afraid I have to conclude the discussion, but this is not all for today. So what's going to follow now is Professor Maskin is going to sign into the book of distinguished guests, and then Rector of Comenius University, Professor Michieta, will present him with Comenius University Medal, and that will be followed by concluding remarks from Vice Rector of the University, Professor Schlacher.
Dear Thank you very much. Dear Professor Maskin, on behalf of our academic community, honorable guests and students, let me thank you very much for your visit here on our alma mater. I'm very grateful for sharing of your ideas with us on such a challenging topic as financial crises definitely are nowadays. At this unique occasion, let me award your memorial medal of Comenius University in Bratislava as a symbol of our and my personal appreciation, and also to remind you of your stay us here or remind you of our city, country, and people, and last but not least, our university. You often refer to the word luck and importance in your autobiography published in a yearbook Nobel lectures. That is why let me wish you a lot of luck and your future career in also personal life. Congratulations.
So we should close this session. We have some duties, and the first thanks goes to Professor Maskin. You made excellent analysis of financial crisis with many proposals and ideas how to solve it. And for me personally, it was very interesting. Your proposal was very interesting for me. In the future, I will invest my money into the potatoes and not into the banks. And more seriously, ladies and gentlemen, we thank you for your participation here today. Many thanks to the Foundation of Tatra Banka. Many thanks to the CERGE-EI. And of course, many thanks to organizers, to young ladies, which invested so much time that we have today this interesting lecture with Professor Maskin. Thank you and see you soon. Thank you. Bye.